The U.S. subprime mortgage crisis was a set of events and conditions that led to a financial crisis and subsequent recession that began in 2005. It was characterized by a rise in subprime mortgage delinquencies and foreclosures, and the resulting decline of securities backed by said mortgages. Several major financial institutions collapsed in September 2008, with significant disruption in the flow of credit to businesses and consumers and the onset of a severe global recession. Government housing policies, overregulation, failed regulation and deregulation have all been claimed as causes of the crisis, along with many others. While the modern financial system evolved, regulation did not keep pace and became mismatched with the risks building in the economy. The Financial Crisis Inquiry Commission, tasked with investigating the causes of the crisis, reported in January 2011 that we had a 21st-century financial system with 19th-century safeguards. Increasing home ownership has been the goal of several presidents, including Roosevelt, Reagan, Clinton, and George W. Bush. However, the FCIC wrote that Fannie Mae and Freddie Mac government affordable housing policies and the Community Reinvestment Act were not primary causes of the crisis. Failure to regulate the non-depository banking system has also been blamed. The non-depository system grew to exceed the size of the regulated depository banking system, but the investment banks, insurers, hedge funds, and money market funds were not subject to the same regulations. Many of these institutions suffered the equivalent of a bank run, with the notable collapses of Lehman Brothers and AIG during September 2008 precipitating a financial crisis and subsequent recession. The government also repealed or implemented several laws that limited the regulation of the banking industry, such as the repeal of the Glass-Steagall Act and implementation of the Commodity Futures Modernization Act of 2000. The former allowed depository and investment banks to merge, while the latter limited the regulation of financial derivatives. Note: a general discussion of the causes of the subprime mortgage crisis is included in Subprime Mortgage Crisis: Causes and Causes of the 2007 to 2012 Global Financial Crisis. This article focuses on a subset of causes related to affordable housing policies, Fannie Mae and Freddie Mac, and government regulation. Legislative and regulatory overview. Deregulation, excess regulation, and failed regulation by the federal government have all been blamed for the late 2000s subprime mortgage crisis in the United States. In general, conservatives have claimed that the financial crisis was caused by too much regulation aimed at increasing home ownership rates for lower-income people. They have pointed to two policies in particular: the Community Reinvestment Act of 1977, which they claim pressured private banks to make risky loans, and had affordable housing goals for the government-sponsored enterprises, Fannie Mae and Freddie Mac, which they claim caused the GSEs to purchase risky loans, and led to a general breakdown in underwriting standards for all lending. Liberals present data that suggest GSE loans were less risky and performed better than loans securitized by more lightly regulated Wall Street banks. They also suggest that CRA loans mandated by the government performed better than subprime loans that were purely market-driven. They also present data which suggests that financial firms that lobbied the government most aggressively also had the riskiest lending practices, and lobbied for relief from regulations that were limiting their ability to take greater risks. In testimony before Congress, both the Securities and Exchange Commission and Alan Greenspan claimed failure in allowing the self-regulation of investment banks. The Financial Crisis Inquiry Commission issued 3 concluding documents in January 2011 to 1. The FCIC conclusions or report from the 6 Democratic commissioners, 2a dissenting statement from the 3 Republican commissioners, and 3 a second dissenting statement from Commissioner Pete Wallison. Both the Democratic majority conclusions and Republican minority dissenting statement, representing the views of 9 of the 10 commissioners, concluded that government housing policies had little to do with the crisis. The majority report stated that Fannie Mae and Freddie Mac were not a primary cause of the crisis, and that the Community Reinvestment Act was not a significant factor in subprime lending of the crisis. The 3 Republican authors of the dissenting statement wrote, "Credit spreads declined not just for housing, but also for other asset classes like commercial real estate. This tells us to look to the credit bubble as an essential cause of the U.S. housing bubble. It also tells us that problems with U.S. housing policy or markets do not by themselves explain the U.S. housing bubble." However, Commissioner Wallison's dissenting statement did place the blame squarely on government housing policies, which in his view contributed to an excessive number of high-risk mortgages. Quote, "I believe that the sine qua non of the financial crisis was U.S. government housing policy, which led to the creation of 27 million subprime and other risky loans, half of all mortgages in the United States, which were ready to default as soon as the massive 1997 to 2007 housing bubble began to deflate. If the U.S. government had not chosen this policy path, fostering the growth of a bubble of unprecedented size and an equally unprecedented number of weak and high-risk residential mortgages, the great financial crisis of 2008 would never have occurred." In a working paper released in late 2012, the National Bureau of Economic Research, the arbiters of the business cycle, presented, "Did the Community Reinvestment Act lead to risky lending?" The economists compared the lending behavior of banks undergoing CRA exams within a given census tract in a given month to the behavior of banks operating in the same census tract month that did not face these exams. This comparison clearly indicates that adherence to the CRA led to riskier lending by banks. They concluded, "The evidence shows that around CRA examinations, when incentives to conform to CRA standards are particularly high, banks not only increase lending rates but also appear to originate loans that are markedly riskier." Deregulation. The FCIC placed significant blame for the crisis on deregulation, reporting, "We conclude widespread failures in financial regulation and supervision proved devastating to the stability of the nation's financial markets. The sentries were not at the posts, in no small part due to the widely accepted faith in the self-correcting nature of the markets and the ability of financial institutions to effectively police themselves. More than 30 years of deregulation and reliance on self-regulation by financial institutions, championed by former Federal Reserve Chairman Alan Greenspan and others, supported by successive administrations and Congresses, and actively pushed by the powerful financial industry at every turn, had stripped away key safeguards, which could have helped avoid catastrophe. This approach had opened up gaps in oversight of critical areas with trillions of dollars at risk, such as the shadow banking system and over-the-counter derivatives markets. In addition, the government permitted financial firms to pick the preferred regulators in what became a race to the weakest supervisor, mortgage and banking regulation. In 1982, Congress passed the Alternative Mortgage Transactions Parity Act, which allowed non-federally chartered housing creditors to write adjustable-rate mortgages. Among the new mortgage loan types created and gaining in popularity in the early 1980s were adjustable rate, option adjustable rate, balloon payment and interest-only mortgages. These new loan types are credited with replacing the long-standing practice of banks making conventional fixed-rate, amortizing mortgages. Among the criticisms of banking industry deregulation that contributed to the savings and loan crisis was that Congress failed to enact regulations that would have prevented exploitations by these loan types. Subsequent widespread abuses of predatory lending occurred with the use of adjustable rate mortgages. Approximately 90% of subprime mortgages issued in 2006 were adjustable rate mortgages. This legislation established an affordable housing loan purchase mandate for Fannie Mae and Freddie Mac, and that mandate was to be regulated by HUD. Initially, the 1992 legislation required that 30% or more of Fannie's and Freddie's loan purchases be related to affordable housing. However, HUD was given the power to set future requirements, and HUD soon increased the mandates. This encouraged subprime mortgages. Repeal of the Glass-Steagall Act. The Glass-Steagall Act was enacted after the Great Depression. It separated commercial banks and investment banks, in part to avoid potential conflicts of interest between the lending activities of the former and rating activities of the latter. In 1999, President Bill Clinton signed into law Gramm-Leach-Bliley Act, which repealed portions of the Glass-Steagall Act. Economist Joseph Stiglitz criticized the repeal of the act. He called its repeal the culmination of a $300 million lobbying effort by the banking and financial services industries. He believes it contributed to this crisis because the risk-taking culture of investment banking dominated the more risk-averse commercial banking culture, leading to increased levels of risk-taking and leverage during the boom period. Alice M. Rivlin, who served as a deputy director of the Office of Management and Budget under Bill Clinton, said that GLB was a necessary piece of legislation because the separation of investment and commercial banking wasn't working very well. Bill Clinton stated, "I don't see that signing that bill had anything to do with the current crisis." Luigi Zingales argues that the repeal had an indirect effect. It aligned the formerly competing investment and commercial banking sectors to lobby in common cause for laws, regulations and reforms favoring the credit industry. Economists Robert Kuttner and Paul Krugman have supported the contention that the repeal of the Glass-Steagall Act contributing to the subprime meltdown. Andrew Ross Sorkin believes the repeal was not the problem. The vast majority of failures were either due to poorly performing mortgage loans, permissible under Glass-Steagall, or losses by institutions who did not engage in commercial banking and thus were never covered by the Act. Capital requirements and risk classification. Capital requirements refer to the amount of financial cushion that banks must maintain in the event their investments suffer losses. Depository banks will take deposits and purchase assets with them, assuming not all deposits will be called back by depositors. The riskier the assets the bank selects, the higher the capital requirements to offset the risk. Depository banks were subject to extensive regulation and oversight prior to the crisis. Deposits are also guaranteed by the FDIC up to specific limits. However, depository banks had moved sizable amounts of assets and liabilities off balance sheet via complex legal entities called special purpose vehicles. This allowed the banks to remove these amounts from the capital requirements computation, allowing them to take on more risk. but make higher profits during the pre-crisis boom period, when these off-balance sheet vehicles encountered difficulties beginning in 2007. Many depository banks were required to cover the losses. Martin Wolf wrote in June 2009, "An enormous part of what banks did in the early part of this decade, the off-balance sheet vehicles, the derivatives and the shadow banking system itself, was to find a way around regulation. Unlike depository banks, investment banks borrow money from investors and invest it. They are not subject to the same oversight or capital requirements. Large investment banks at the center of the crisis in September 2008, such as Lehman Brothers and Merrill Lynch, were not subject to the same capital requirements as depository banks. The ratio of debt to equity rose significantly from 2003 to 2007 for the largest 5 investment banks, which had $4.1 trillion in debt by the end of 2007. FDIC Chair Sheila Bair cautioned during 2007 against the more flexible risk management standards of the Basel II Accord and lowering bank capital requirements generally. There are strong reasons for believing that banks left to their own devices would maintain less capital, not more, than would be prudent. The fact is, banks do benefit from implicit and explicit government safety nets. Investing in a bank is perceived as a safe bet. Without proper capital regulation, banks can operate in the marketplace with little or no capital, and governments and deposit insurers end up holding the bag, bearing much of the risk and cost of failure. History shows this problem is very real, as we saw with the U.S. banking and S&P crisis in the late 1980s and 1990s. The final bill for inadequate capital regulation can be very heavy. In short, regulators can't leave capital decisions totally to the banks. We wouldn't be doing our jobs or serving the public interest if we did. Boom and collapse of the shadow banking system. The non-depository banking system grew to exceed the size of the regulated depository banking system. However, the investment banks, insurers, hedge funds, and money market funds within the non-depository system were not subject to the same regulations as the depository system, such as depositor insurance and bank capital restrictions. Many of these institutions suffered the equivalent of a bank run, with the notable collapses of Lehman Brothers and AIG during September 2008, precipitating a financial crisis and subsequent recession. The FCIC report explained how this evolving system remained ineffectively regulated. In the early part of the 20th century, we erected a series of protections: the Federal Reserve as a lender of last resort, federal deposit insurance, ample regulations to provide a bulwark against the panics that had regularly plagued America's banking system in the 19th century. Yet, over the past 30+ years, we permitted the growth of a shadow banking system, opaque and laden with short-term debt that rivaled the size of the traditional banking system. Key components of the market, for example, the multi-trillion-dollar repo lending market, off-balance sheet entities, and the use of over-the-counter derivatives, were hidden from view. Without the protections we had constructed to prevent financial meltdowns, we had a 21st-century financial system with 19th-century safeguards. Significance of the parallel banking system. In a June 2008 speech, U.S. Treasury Secretary Timothy Geithner, then President and CEO of the NY Federal Reserve Bank, placed significant blame for the freezing of credit markets on their run on the entities in the parallel banking system, also called the shadow banking system. These entities became critical to the credit markets underpinning the financial system, but were not subject to the same regulatory controls. Further, these entities were vulnerable because they borrowed short-term in liquid markets to purchase long-term, illiquid and risky assets. assets. This meant that disruptions in credit markets would make them subject to rapid deleveraging, selling the long-term assets at depressed prices. He described the significance of these entities. In early 2007, asset-backed commercial paper conduits, in structured investment vehicles, in auction-rate preferred securities, tender option bonds and variable-rate demand notes, had a combined asset size of roughly $2.2 trillion. Assets financed overnight in tripartite repo grew to $2.5 trillion. Assets held in hedge funds grew to roughly $1.8 trillion. The combined balance sheets of the then 5 major investment banks totaled $4 trillion. In comparison, the total assets of the top 5 bank holding companies in the United States at that point were just over $6 trillion, and total assets of the entire banking system were about $10 trillion. Quote, he stated that the combined effect of these factors was a financial system vulnerable to self-reinforcing asset price and credit cycles, run on the shadow banking system. Economist Paul Krugman described the run on the shadow banking system as the core of what happened to cause the crisis. As the shadow banking system expanded to rival or even surpass conventional banking in importance, politicians and government officials should have realized that they were recreating the kind of financial vulnerability that made the Great Depression possible, and they should have responded by extending regulations and the financial safety net to cover these new institutions. Influential figures should have proclaimed a simple rule: anything that does what a bank does, anything that has to be rescued in crises the way banks are, should be regulated like a bank. Quote, he referred to this lack of controls as malign neglect. Quote, some researchers have suggested that competition between GSEs and the shadow banking system led to a deterioration in underwriting standards. For example, investment bank Bear Stearns was required to replenish much of its funding in overnight markets, making the firm vulnerable to credit market disruptions. When concerns arose regarding its financial strength, its ability to secure funds in these short-term markets was compromised, leading to the equivalent of a bank run. Over 4 days, its available cash declined from $18 billion to $3 billion as investors pulled funding from the firm. It collapsed and was sold at a fire sale price to bank JP Morgan Chase March 16, 2008. American homeowners, consumers, and corporations owed roughly $25 trillion during 2008. American banks retained about $8 trillion of that total directly as traditional mortgage loans. Bondholders and other traditional lenders provided another $7 trillion. The remaining $10 trillion came from the securitization markets, meaning the parallel banking system. The securitization markets started to close down in the spring of 2007 and nearly shut down in the fall of 2008. More than a third of the private credit markets thus became unavailable as a source of funds. In February 2009, Ben Bernanke stated that securitization markets remained effectively shut, with the exception of conforming mortgages, which could be sold to Fannie Mae and Freddie Mac. The Economist reported in March 2010, Bear Stearns and Lehman Brothers were non-banks that were crippled by a silent run among panicky overnight repo lenders, many of them money market funds uncertain about the quality of securitized collateral they were holding. Mass redemptions from these funds after Lehman's failure froze short-term funding for big firms.